It's reported for each period. So here we have direct and indirect methods. Where is it? Why is it not coming up? Okay. So the direct method, this is what it looks like. Cash flows from operating. Cash received from customers, cash paid for administrative expenses would be the direct method. Indirect method, start with net income and adjust net income for non-cash effects. Okay? So basically here you have a net income number that's on the accrual basis and you're adjusting it to cash basis. That's what you're doing. Taking out everything that doesn't affect cash. What do you think, just looking at these two, what do you think benefit is to one over the other? Yes? For the direct method or the indirect, which one are you talking about? Indirect is more specific. Okay. It gives you more of a breakdown. Okay. Other thoughts when you're just looking at them? There's no right or wrong answer. I'm just curious what you guys think. Yes? Definitely indirect method is more simple. Yes. Indirect method is definitely more simple to derive. Other thoughts? Yes?
Direct allows you to see where your cash is going, how many accounts it breaks it out, so you don't know what the customer is.
Right, you don't really, like increase in accounts receivable, what does that necessarily mean to you? Nothing specific, but this means a little bit more. Is that what you're saying? Right, you get, right, other thoughts? Other thoughts? Yes?
I know that companies don't always use the direct method. I think indirect is more common to find on financial.
Indirect is definitely much more popular in the U.S. to use than the indirect method. Yes? Right. However, you always should be getting a balance sheet in conjunction with your statement of cash flows. You should always have all of these things to look at together. Yeah?
I think it starts off with the net income. It gives us an idea of the starting point.
Right, and actually that's something I was kind of looking for, right? Because if you start with net income, if you are a person who likes the indirect method, a proponent of the indirect method might say that the indirect method gives you your accrual basis and reconciles back to cash basis. Right? It like takes you from accrual to cash. This is kind of just straight up cash basis. Right? It's just straight up, if you were never to have reported on the accrual basis, that would be your cash basis income statement. And some people say, you know, there's a reason why we report things on the accrual basis. The cash basis numbers are not so useful. Right? So maybe, even though this seems really lovely to give all these clear numbers, this is really just a cash basis income statement. We're not really supposed to be reporting on cash basis. We should be reconciling between cash and accrual basis. This doesn't necessarily reconcile back, right? It just gives you straight up what it would be if it was on the cash basis. Okay? And other proponents of the indirect method, right, I heard some good ones. It's a lot easier to prepare. A lot of companies say they don't have the information available to prepare the direct method, so we simply and I did hear there's a lot more breakdown of information on the indirect method, although a lot of people would say they don't know what that information really means. Increase in accounts receivable, decrease in whatever, you know, not necessarily giving you information that you know what to do with, but it's there nonetheless. So, so this is, again, direct versus indirect. So what I'd like to do now is move forward. What did I do with my stuff here? Okay. I'm going to skip the IFRS versus GAAP for now. And I want to get into an example so we can just start to make some sense of this and start to get into preparation. So I handed out this handout because I figured most of you wouldn't be able to see this that well, which is just giving us information that we would need to prepare a statement of cash flows. Okay? So we have here a balance sheet and we have an income statement. And I've given you the changes. So I'm saying here on the balance sheet, I'm giving you the changes year over year. Which method do you think this relates to more? Indirect method. All right? So we're going to go ahead and prepare information that would go on a direct method, and then we're going to look at the indirect method, statement of cash flows. Okay? So on the direct method, what you have here, the direct method, you're really starting with your income statement. So you have here an income statement, and you're going to take your income statement, You're going to look at your revenue and expense item. You're going to adjust the related balance sheet accounts to come up with your cash receipt or your cash payment. So again, if you're using the direct method, you're starting with the income statement. That's what you're concerned about under the direct method. You always want to start with the income statement. If you're starting with the indirect method, you're going to start with the balance sheet. Once you have your net income number, you obviously start with net income, but you're kind of focusing more on balance sheet. If you're using the direct method, you're going to start by looking at your income statement, and you're going to find the related balance sheet account to determine what your cash receipt or payment is. So let's find out what that means. So in this example, what is sales in the beginning? What is sales, as of the end of the year? $590,000. So here, sales is related to which two accounts? Well, really it's related to accounts receivable. Okay? Sales is really related to accounts receivable, right? Do you understand why that is? If you make sales and you don't receive cash, where does it go? Accounts receivable. So you have really one of two things happening when you make sales. You debit cash and credit sales, or you debit accounts receivable and you credit sales. Okay? So in this example, when you find the related account, so you're looking at sales here, you have $590 in sales, and you look down in your balance sheet, and really what's related to that would be accounts receivable. Got it? So accounts receivable had a beginning balance of 40 and an ending balance of 60. So here, we have a beginning balance of 40 and ending balance of 60. We assume that we would have, for these $590 in sales, we would have debited accounts receivable for $590 and credited sales for $590. Okay? Except some of those sales we actually received cash. So how much would we have to credit accounts receivable for to get to our ending balance? $570,000 to end up with a $20,000 increase. Would have had to have been credited to AR and debited to cash. Okay, I'm going to go over that again. This is how we come up with cash collected from customers. So you have sales of $590. Okay, for the period. Accounts receivable went up by $20,000 during the period. You see that? So a very, very, quick way of doing that, which I don't want to, for those of you who, let me do this very quickly and then I'm going to go through the long process. So if your sales are $590 for the period and accounts receivable went up by $20,000, the idea is that you made sales of $590, but you still are owed $20,000 of that, right? So how much cash must you have received? $570. You have to subtract it. If accounts receivable goes up, you didn't receive that cash, therefore sales is at $570. Okay, cash collected, is at $570. The journal entry way of looking at this, or the T account way of looking at this, is you have sales of $590, so you make this assumption that you have a journal entry to accounts receivable for the $590. Okay? Because the idea is more, you just have to make these assumptions when you're looking at a statement of cash flows as you're learning it in the beginning. You assume that nobody's paid you in cash, as of just right off the bat for this journal entry. Then you have to say, but my beginning balance in receivables was 40. If I add $590 to that, I'm at what? $630. But my ending balance is only 60. How did I get to my ending balance? I must have had to credit receivable and debit cash for how much? $570. Okay? Therefore, cash collected is $570. Okay? Cash collected from customers is $570. So in order to figure out cash collected from customers, the process is you have to look at the sales and you have to find the related balance sheet accounts. And then you have to make an adjustment for whatever the related balance sheet account is telling you. So in this case, accounts receivable went up, therefore cash collected is not that entire amount, it's less. If accounts receivable had gone down, what would you have assumed? You have to add it, right? If beginning accounts receivable was 60 and ending was 40, then it would be 590 plus another 20. Okay? So again, this is not, and this is what I'm going to tell you, this is not about memorization. This is about understanding what you're doing. You will never, ever be able to do this if you try to memorize it. This is all about trying to intuitively understand why you're doing what you're doing. Telling you, I've taught this like many times, and every time people say, you're right. When I tried to memorize it, I couldn't figure it out. When I tried to think about it, I can figure it out. Okay? So this is really going to require you to think and try to understand why you're doing something, not just trying to memorize a formula, because you will never be able to do this doing it that way. So again, you make the assumption when you have a sale that no one's paid you in cash. You look at your change in the related balance sheet account. Okay? I'm showing you T accounts here to make it extra simplified and stepwise, but you could just as easily have, if you understand, sales is 590, accounts receivable went up by 20,000, therefore you couldn't have collected it all, then you have to reduce cash. Your cash collected goes down by 20,000, okay, from sales. Any questions on what I've said? Did you learn this already? Did you learn this a different way?
We have a form.
You have a formula.
Sales minus change in accounts receivable.
Okay. But I'm taking you through, I'm trying to get you to intuitively understand why you're doing it. So at least that formula is like completely coinciding with what I'm showing you.
Yeah.
Okay, is everyone with me here? Okay. So let's continue along. How much I want to get into this. I'm thinking that, let me go into cash paid to suppliers, and then we're going to do an exercise. I'm going to kind of go a little out of order. All right. So cash paid to suppliers. So here's a little bit of a formula, if you like formula. So you have to add any increase in inventory. But again, this is not, ultimately you're going to have to understand this. You have to add an increase in inventory to come up with your cost of goods sold, subtract any decrease in inventory, add a decrease in accounts payable, and subtract an increase in accounts payable. I don't know how far this is going to take you, but this is what you have to do to come up with, to adjust your cost of goods sold, the cash basis. Yeah. What? Right, you have to add any increase, or you have to subtract any decrease. You have to add any decrease in payables, and subtract any increase. So if you have cost of goods sold, okay, and accounts payable went up, you have to add that to your total cost of goods sold to come up with cash paid. No, you have to do all. You have to do one. You may have to do one or the other of these things. Okay. All right. I want to go slowly through this. I need to figure out how to. I feel like I've lost everyone. How many of you are totally lost, or not totally lost? What? Where, like, I'm not sure where, I just feel like yeah. You add the decrease. Yes, those are the options you have, yes. These are the options you have. So how many of you are not, where am I losing people? Or are you not lost, and I'm just thinking you are?
So we're just trying to find out how to...
Cash, so you figured out, we went through cash paid to customers. Now, next is cash paid to suppliers. We have to we're going to look at cost of goods sold. Ready? All right. So I think what I'm going to do here is I'm going to skip here. So cost of goods sold was how much? How much was cost of goods sold on the sheet I gave you? 300,000. So you have to start with cost of goods sold. What happened with accounts payable? Right. So you have to, right? You have your cost of goods sold. What did I say to do with an increase with a decrease in accounts payable? Add it. Okay, accounts payable went down. You have to add it. So here, you have cost of goods sold. You have accounts payable that went down. And I said also look at the related inventory account. What happened to inventory? It went up. And an increase in inventory has to be added. So if you have inventory that went up by 14,000, your total cash paid is how much? 319 paid to suppliers. So if I scroll to the end, your cash paid is $319. So what happened here? Now let's try, so looking at the formula, we can get to $319. Let's figure out what happened. Cost of goods sold for the period is what you, theoretically, right, is the inventory that you sold. Okay? So you always start with that number. Okay? If inventory went up, that means in addition to what you sold, you also bought more inventory. Right? If net, even with some of that inventory going into cost of goods sold, inventory still went up, that means that you must have bought even more inventory than you sold. That makes sense? So that has to be added to what you paid suppliers. Right? Okay, that has to be added to the amount paid for the period. Okay? And if accounts payable went down, what does that mean? I even paid more. Maybe I had some inventory that I bought last period that I didn't pay until this period. So it was sitting in my accounts payable. So now I paid it. That means that cash paid to suppliers went up. So both of those have the effect of increasing the amount paid to suppliers. So cost of goods sold, add any increase in inventory, and add any decrease in accounts payable. Because in all of those instances, the idea is that you paid your suppliers more of the money that you owed them. Okay? You purchased more inventory. Yes?
So accounts payable is only used for purchasing inventory?
The idea is, this is why, now in a book, what I'm teaching you, yes. The reality is that that's not really always the case, which is why a lot of people, companies say they don't track information. It's not easy to put things on the direct method because this information is not necessarily so clear-cut. So I'm showing you how to do it I'm showing you how to do it in the book-wise. Okay? This is the process that you would have to go through, but the reality is that a lot of companies can't pull this information apart so easily.
So we're probably never going to do that.
You actually maybe if we end up going to IFRS, because IFRS will require you to use the direct method. Okay, so I can't say that you'll never be doing this. I have seen direct method cash flows, but I don't see them frequently. Okay, some companies use the direct method. Most of them use the indirect method because it's much more simple. Okay, but you still have to understand and be able to learn the direct method. And I'll tell you, most people don't know how to do the direct method, which is why I think a lot of people don't do it. Okay, but you will learn how to do this through this class. You will be doing this. Yes. Did someone else have a question? Okay. So cost of goods sold. I want to go through that again. If accounts payable goes down, that means you paid something. If you paid something, that's reported as cash paid. You make these assumptions that cost of goods sold, you paid everything in cost of goods. You start with that whole number there. Okay? If cost of goods sold, if inventory had gone down during the period, we say what? What would you do? You would subtract it from cost of goods sold. So you have this cost of goods sold number. We can't try writing this out. So if you have cost of goods sold, it's like you start off this, it's like this bubble. This is your cost of goods sold for the period. It's made up, all your inventory becomes your cost of goods sold. Okay? If inventory decreased during the period, if inventory went down, that means the idea intuitively is that you didn't buy anything during the period. You used last period's inventory. Does that mean that you paid anyone this period? You didn't pay for that, right? So you would subtract that from cost of goods sold. That would come out of the cost of goods sold number that you're going to report. Okay? So you have an inventory number, and the idea is you could have used all of last period's inventory, stuff you paid for last period, stuff you bought last period, not bought anything new. Okay? And all the inventory that comes from last period that you sold in this period, that you didn't, forget even paying at this point, okay? Let's keep it really simple. All the inventory that you get in each period, you pay for in that period. Okay? So in a really simple world, if you used only the inventory that you paid for last period in this period, did you pay any suppliers? So I'll put some numbers. If you had inventory of $100 rolled over from last period, and you sold $50 of that inventory in this period, how much was paid to suppliers in this period? 0, because you paid for it all last period. Okay? So if inventory, here you're taking out some of this is all coming out of the prior period's inventory. Okay? So the idea is that if and what's going to happen to your inventory balance when you sell that $50 worth? It's going to decrease. So if inventory goes down, then cost of goods sold, then the number that you're going to report for cash paid goes down, because you are just taking inventory that you had already from last period and paid and using it up in this period. Okay? Separately from that, you have accounts payable. So so now complicating this world a little bit, some of that $100 in inventory from last period may not have been paid. So when accounts payable goes down, that means you paid some of it. So you have to always start with this bubble of cost of goods sold and say, what happened to my inventory and what happened to my accounts payable? Both of those play in to what your ending balance is going to be in what you paid to suppliers. Okay? So if accounts payable goes down, that's an easy one. I paid people. That means it increases the amount that cash paid to suppliers. If inventory goes up, the idea is I bought more. Okay? And also, you assume for the purposes of your cash flow statement that was also paid. Okay? So that would take you to ending cash paid to suppliers, which is here. So now we've gone through this. We've gone through this. I'd like to do an exercise and then come back to these last 3. Oh, we don't even have time to do an exercise. Class is like over, isn't it? That's really stinks to go through all that and not even do an exercise. All right. All right, you know what? We'll start on this next time. I will probably go back over this again. I want to look at that formula to make sure that I hopefully can reconcile that for you. And I'll probably open up a homework, balance sheet and cash flows, and we'll continue with this next week. And then we have a test in 2 weeks, I think. Yeah, so great. Fabulous.